introduction by Francie Mayberg from the knowledge management team. And then secondly, we'll have an introductory presentation by Charles de Wet, who's recently joined our tax team and is our new VAT specialist. And what Charles will be doing is just taking us broadly through what he does, his area of expertise, and then what the things are that we as commercial practitioners should be aware of in the context of VAT. And obviously, that's as per usual in the firm. The point is not that we should know everything about it, or that we should hold ourselves out as specialists in the area, but rather that we should be alive to issues which may crop up in commercial transactions, and know when to get proper advice. And as usual, in those areas, there are hidden traps where it's quite easy to get tripped up if we don't know what we're facing. So always good to have an awareness of those types of issues. So on the due diligence templates, just to sketch a little bit of background, and I did allude to that in the meeting invite, but the intention is for us to have a workable and user-friendly due diligence template in the department, which is then adopted and used regularly, okay? And in discussion, and the reason for that obviously is A, if we're all familiar with the template and the format, it becomes easier to use it. B, if we are working across teams or with different people, you don't have, as an associate, for example, to learn somebody's different style every time you work with them. And also, as a partner working on a project, that we can have the comfort that if we're using the firm template, then all of the appropriate tops and tails are there, so that we have our disclaimers in place, we've got our assumptions and qualifications, etc. So the bottom line is that using something which is uniform and well known assists all of us. Okay, and what we have found in discussions with Tonya and Francie was that there was not the general take-up that we would like to see from our templates. And what we had picked up was that some people have different styles and ways of approaching things. So myself and the knowledge management leads in each of the teams sat down with Francie and Tonya 2 to 3 weeks back and worked through issues that we picked up, and devised some amendments and improvements to our templates, hopefully to A, make sure that people are comfortable with how they work and that we're addressing people's stylistic requirements, and B, also to make sure that what we're doing is consistent with what we're seeing in terms of best practice, and particularly in international firms. So the upshot of all of that is that we have a new template, or an upgraded template rather, which we think works well. And Francie is going to take you through that in this discussion. And then we will also have some time for general questions and queries around that. So Francie, over to you.
Thanks for that, Jules, and for the background as well. I'm going to just quickly share my screen, just to pull the report up for you, and just shout if anyone is not able to see it. So yeah, I'm going to just quickly run you through the structure of the report and some of the key elements of the document, so that when you see it for the first time, it's not completely unfamiliar, and also briefly touch on some of the more important points that we did workshop extensively with the team leads a few weeks back. So on the cover page, we've got a set of sort of general explanatory drafting notes pertaining to the template. As a side note, I think some of you might be very happy to know that the knowledge management team is actually in the process of moving away from the firm's historical style of drafting templates, which had the separate keys and all the variables and the superscripts. And what you'll find now is that all of the most important notes and guidance around optionality are getting folded into the templates themselves. We think that this will hopefully make them a lot more user-friendly. So this is now what you'll see here is all of the most important drafting notes we've actually just put up front in the document for you to have a squiz at, just to refresh your memory before you start delving into the details of the document. So that's just the cover page. Then scrolling down, and you'll see it's also really nicely branded in accordance with the ES colors. Lydia and the rest of the marketing team did a really nice job. Our due diligence questionnaire, which is also new, is also branded in the same sort of style. So the two actually fit really nicely together. Okay, so part one, you'll see here contains all of the definitions that are used in the report, and you'll obviously be able to add and delete definitions as will be appropriate for your report. We debated a little bit whether to present the definitions in table format and whether to rather set them out at the back end of the report. But in the end, I think the overwhelming preference amongst the workshop members was to just have the definitions up front and in our paragraph format as per the usual E&S house styles. And you'll see, just to my earlier point, the entire template is sort of littered with little red notes here, so you can actually read the note, which gives you a little bit of guidance around how to deal with a particular section, and then once you've read it, you can just click on the little square at the bottom of the table and delete it, and the note will be removed for purposes of external circulation. Okay, part two. So this is intended really to just set out a few introductory matters and some of the slightly more administrative components of the report. So, for example, the scope of the report, i.e. what you've actually been instructed to do, and then the specifically agreed parameters around that. And very importantly, E&S's assumptions and disclaimers. But on the basis that the actual detailed assumptions and disclaimers will not be incorporated here up front, but we simply cross-referring to an annexure, annexure D. Let me take you there. So here they all are at the back. I think the team leads felt quite strongly that these shouldn't be included up front in the DD report, just with a view to making the document seem a little bit more commercial and a little bit less intimidating for clients. And then just on the assumptions and the disclaimers themselves, quite a lot of work actually went into this piece between Tanya and myself, because when we looked at all the various reports which were being used across the firm, we found that there was a considerable amount of duplication and repetition in this area, literally pages and pages of limitations, which all by and large sort of said the same thing, and they were grouped under the wrong headings, and a classic case of attorneys just copying and pasting sets of disclaimers from older reports and various reports. So we try to cut out all of that repetition, and so what you'll find here is really the crux of what we think needs to be said as regards liability. But obviously, if you think we've missed anything major, please don't hesitate to reach out, and then we can discuss that. Okay, so moving back to the next part, which is then part 3, is where you'll find the executive summary. And the executive summary also makes provision for what we call a risk rating, or sort of a grading of issues. So here's a little column in the executive summary table, and then you can highlight it in accordance with the category of risk that you've identified. So red, if the issue as it stands will effectively prevent the transaction from going ahead. So for example, if there's an approval that you need from a regulator and it's going to be impossible to obtain that approval. Yellow or orange is something which doesn't necessarily constitute a legal bar to the transaction, but it could nonetheless materially prejudice the client, and so it still needs to be addressed. Maybe through a purchase price adjustment or a warranty or an indemnity, and so forth. So, for example, non-compliance with POPI, which can be addressed. It won't necessarily be a deal breaker. And then green is just for all your other material risks. I do think worth noting in this context, though, that the report sort of assumes and has been formulated on the basis that the executive summary as a whole is really intended to deal only with material risks. So even if it's a green risk, it should still be a material issue. It's simply a less serious material issue than a red issue or a yellow issue. And I think it's maybe worth mentioning also around the risk rating. We debated quite extensively with Jules and Duran and the other members of the team leads of the CorpCom department whether or not we actually should include this risk rating, because it sort of borders on giving commercial advice in a sense. But in the end, we felt that we should include it because it's something that clients are really starting to request more frequently. They want this sort of level of practical advice. And it just makes the report a little bit easier for them to navigate. Appreciate, though, that it might sort of place a more onerous burden on the lead attorney. It's not always easy to categorize these risks. But yeah, I think the sense is that clients want it and we should be prepared to give it. But perhaps just a caution that we've tried to steer clear of using wording in the risk rating which could be construed as constituting commercial advice. At the end of the day, we're a law firm and we can only advise on legal issues. So, we really commenting on things which constitute material legal impediments and legal bars to implementing the proposed transaction. So we've not used wording like deal breaker and things like that, which sounds a little bit more commercial than legal. And I mean, we do have our standard disclaimers around this in the annexure to say we're not giving commercial advice, we're giving legal advice, but I think it's nonetheless important to be quite clear and consistent around these aspects throughout the report. That's the risk rating and the executive summary. And then part 4 is just the detailed findings, from where you'll lift the executive summary. Ultimately, you'll see both parts 3 and part 4. We decided with the team leads to present this in table format. We think it's just a little bit neater and user-friendly for commercial clients. But obviously, you know, if your circumstances warrant a deviation from this format, then that's 100% fine. I think sometimes for some of the more regulatory sections, it's sort of easier to write that in paragraph style, and you know, in that regard, it's obviously 100% okay to change the format for those sections. And then part 5 is just the collection of annexures, which you will attach, and these will obviously depend on your report and your circumstances. And that's pretty much my story, Jules. I mean, yeah, we can take some questions and comments now. Otherwise, you know, if there are any questions or things come up around this template or any of our other templates, please don't hesitate to contact either Tanya or myself. We obviously welcome any feedback, actually rely on your feedback. At the end of the day, you guys are the experts, and we just want to work collaboratively to draft templates which work for you and that make your lives easier.
Great stuff. So thanks very much, Francie. And maybe before I open up for questions, just to reiterate that last point that Francie made, the process of updating the report was actually a really good and constructive one, because what we were able to do was to track usage, to see how people were perhaps deviating from the standard, or the different things that were coming up in terms of approach to the reports. And we were able quite quickly to revise the report and hopefully get something which is, as we said at the beginning, more user-friendly, you know. So my kind of idealistic hope is that we'll be able to do this eventually with the other standard templates in the department as well. But all of that obviously is dependent, one, on try to use the things, and two, please give us your feedback, because then we get into kind of the positive loop, you know, of making sure that we're adapting in real time, and we're giving you as practitioners formats and content which actually works. So I think with that background, if there are any questions or comments, please feel free.
Yes, Julius, it's Stephen speaking. May I ask 2 questions?
Go ahead, Stephen. Thanks.
In my view, DDs are really high risk. And I noticed as you were scrolling through, Francie, that when we do limitations, you refer to our standard terms in relation to the limitation of our liability.
Yeah.
Not sure what other big firms do, but I would be inclined, subject to being competitive, to say our liability will be limited to 10 times our fee or something like that. If we get pushback for whatever reason, then one can concede. But I'm worried here about gross negligence and a repudiation of the policy. So I would think that commercially from our side, if it doesn't non-suit us, I would go for that. That's the first point. The second is, when you talk about material legal risk, you know, I'm not sure I understand, and as you know, I've been around a long time, what that actually embraces. But when you get more junior people doing due diligence, I think you're also going to find that there is a problem in understanding precisely what is embraced by that. So I would think, insofar as possible, one should give some sort of definition or guidance as to what is a material legal risk as opposed to a commercial risk.
Okay, so Stephen, to respond to, am I? No, I'm not on mute. To respond to your first question, 100% agree with you. So what we've done is in the annexure, which sets out ENS's limitations of liability and assumptions and so on, there's a one-liner which says that the limitations of liability are set out in ENS's standard terms of engagements apply. And we've assumed for purposes of the report that the relevant attorney has, as is mandatory and firm policy, provided the client with a copy of our standard terms of engagement and the mandate letter, which set out in considerable detail the firm's limitations on its liability. And it includes monetary limitations. I think at the moment the standard limitation is that our liability is limited to anything that we recover from our professional indemnity insurance. So, and obviously if that is tweaked in a specific matter, then the same liability will carry over to the due diligence report. So we've done that simply to avoid having to repeat all of those details regarding limitations on ENS's liability in the body of the report, and obviously also to try and avoid any conflicts which may arise. We think that it's better for everything just to be dealt with in one place.
No, I understand that, Francie, but I'm not sure that I'm making myself clear. We've got clients where we've got mandates that go back a long time, so you won't enter into a new mandate. What I'm suggesting is that when we do a due diligence, we override, if we can, standard terms and conditions. Because I would think that most of us just use the standard. We don't limit liability to anything other than that which is there. It's there. I'm suggesting that we actually in DDs limit our liability further and say, notwithstanding anything in your terms and conditions, our liability for the DD will be limited to 10 times our fee.
So,
but
Stephen,
that's a hard debate now. I think the committee must just have a look at it. I would be more comfortable with that for the firm, but we don't have to debate that now.
So Stephen, I was actually going to make the same point because I'm alive to the concern. I think we all are. I think it is a question of practicalities as well. Whether a long-standing commercial client is, for example, going to accept that or not. So I think it could be very sort of matter specific and depending on who you're dealing with. But agreed, I think it is something that one should consider when you are, when you are compiling the report and deciding who you're dealing with, basically. Okay, then on the second point, Francie, do you maybe want to just go through the thinking on that in terms of the risk rating?
Yes, I can. So, I think the concept of a material, I'm just scrolling back up to okay. I'm just going to share my screen with you again so you can see. Yeah, okay. So, so within the concept of a material legal risk, we've, as I mentioned previously, identified these three categories of risks, red, yellow, and green. And we've tried to actually do exactly that in the report, Stephen, is say that red is a material legal risk, which as it stands constitutes a material legal impediment to proceeding with and implementing the proposed transaction. And here we, as I mentioned earlier, again, these are really the things which are a legal bar to implementing the transaction. For example, if there's a Companies Act approval which is required, a shareholder approval which is required, but it's impossible to hold the shareholders meeting because you can't establish a quorum for failure of being able to reach certain shareholders if it's a large public company, for example, or you need a DMR approval and it's not going to be forthcoming, or really things which actually prevent you from going forward. Yellow we've defined as it's not a material legal impediment to proceeding with the transaction, but it's a serious legal risk nonetheless, which needs to be addressed prior to implementation. These are typically the things that you'll find can be addressed through contractual means, warranties, indemnities, and purchase price adjustments. And green is all the other things. For example, the company's books, corporate records are not in order, so it can be addressed probably even after the implementation. It doesn't constitute. There's an impact, but it doesn't constitute a threat to the transaction from a legal perspective. And we've also given a couple of these examples in this little red note here to sort of just as a benchmark to try and guide the thinking around these things. It is a bit hypothetical, and I know that these things get a little bit tricky as you start working on a transaction, but this is this is sort of as far as we felt that we could go with defining and giving context around what we think a material legal risk should be. And obviously it will also depend on the transaction that you're working on and the client and so on. So but we've tried to define it as best we can.
Thank you. So if I understand correctly, competition approval, is that a material legal risk and other regulatory, or is that, what is that? It's not
I think it would be
bar. It's something which you've got to obtain as a condition to the transaction proceeding. So would I put in competition as a red?
I think it would only be a red risk, Stephen, perhaps if the Competition Commission announces that it's placing a moratorium on all decisions for the next 2 years for some reason, so you can't actually get that approval. If it's something that's just to be dealt with, but it's not an impediment to proceeding with the transaction, then I would classify that as yellow. And perhaps we can clarify that, yellow is also like, that category of items which just needs to be dealt with.
Thank you.
Stephen, maybe if I can just add a point to that. If you have a look at the wording, and obviously we haven't had a chance to do that now here, but in the assessment we do also make it, or in the explanation, we do also make it very clear that this is our assessment based on what we've seen. The client ultimately has to make up its own mind in relation to the grid, the various levels. And it must also read our recommendations and our assessment in conjunction with all other due diligence reports that it receives, because obviously there's finance, et cetera, et cetera. So I think the challenge, and I think we're all alive to that, is on the one hand, we do want to say, look, this is the best that we can do, and don't sue us if we're wrong. Okay. But on the other hand, nowadays, I think increasingly the client is looking to us to make to give assessments and to give sort of practical judgment call type advice. So this is an attempt to walk the balance. But realizing we really need to be seen to add value to transactions, and I think, as very often where this kind of thing lands is you walk into a meeting with the client, and you've got 15 advisors around the table, and they say to you, E&S, you've got 20 minutes to tell me whether I can do the deal or not, and that's typically where it lands. So hopefully what we've done is to strike an appropriate balance. But obviously what is important is that ultimately the executive who's running the matter needs to be on top of the detail sufficiently to be able to engage with the people who prepared the report and say, okay, why did you think this is an issue? Explain that to me, and ultimately I've got to sign off on it. So yeah. Cool. Sanj.
Thanks, Jules. Thanks, Francie. Question from my side. Often we ask to. I mean, these reports are important, and they're important to protect us as well. But often, clients are like, look, I don't want to read I'm not reading a 300-page document. Can you give us a presentation, either to the board or to relevant people at the client, regarding the sort of high-level outcomes of the due diligence? And often we asked to do a presentation of sorts. So I was wondering whether there's been any thought to preparing sort of a template, sort of PowerPoint type presentation, with some infographics or something like that, that we can use, and may have some, a summary of the disclaimers or assumptions at the back of that presentation, that we can use to actually present the findings of the report, because I think that would be quite useful, because often we sort of trying to do these things ourselves.
Sanjay, I know you often use presentations format. Tanya has told me. So I mean, I think that's a great idea, and I'll definitely take it back to Tanya, and we can sort of try and align it with the limitation, the liability aspects of the report itself. Definitely.
I agreed. I think that is a very good suggestion.
Thanks.
Thanks, Sanj. Okay, so that's the due diligence reports. Thanks very much, Francie, and thanks for the work in putting all of this together. And look forward to seeing everybody use them. And I must actually say, I had a look at one over the weekend where I was just looking at the executive summary, but it was done on this basis. And I really think that in the current format, it reads well. So thanks for that. So then our guest star for the day, and as usual, I'm very glad to see that he's actually on the call. So Charles, welcome. I did a little bit of an intro beforehand, before you joined us. So I've sketched the background, and I've told people that you're here to put the fear of God into us when it comes to that. And other than that, it's over to you. So thanks very much, and we look forward to listening to you.
Yeah, thanks very much, Julius, and good morning, everybody. Thank you for the opportunity to talk to you about value-added tax. Can somebody just confirm that my slides have come up?
Yeah, we can see them, Charles, but you may want to do them just as a slideshow. I think that they're a little bit small on my screen.
Okay, let me try and do that quickly. That better? So I thought, I mean, I joined the firm in October last year, and sort of still finding my way around it a little bit. It's been interesting in COVID times, but I thought it was worthwhile, introducing myself and just talking about the VAT service offerings that we have. So from a team perspective, we do have dedicated VAT specialists sitting in the tax team. Essentially there are two people sitting in Johannesburg, which is Seelan Munsami and Anli Giles. Who are now reporting to me, and then we've also in Cape Town got Joe Paula Roman mainly, who also has got quite a lot of VAT experience. From my perspective, and I think I qualified in VAT by default more than anything else. I was in fact at the South African Revenue Services in September of 1991 when VAT was introduced, and part of the team that was responsible from the Commissioner's Office for the implementation. I think that I signed at that point in time about 2,500 rulings. I did have signing powers at least on the interpretation of the VAT Act, and then kind of by default decided when I left them that I should stick in VAT because it was the only thing that I do. I then joined PwC in 1994 and spent my career there, where I started as a VAT manager and ended up as leader of the African indirect tax practice, and then exited them last year to joined ENS. And I think that, sort of the reason why it's important to have conversations about VAT generally is, simply because it's often a forgotten tax. It's something that often, sort of at the last moment, somebody says, have we thought about the VAT on it? The first example that I remember in my career about this, and I'm sure that some of you will recall, there was the merger of Bullion Bank with NBS, where Adams drafted the agreement and there weren't any VAT clauses, and we ended up with a really significant VAT cost. I think that was the first time that from a VAT perspective, I actually stopped the signing of the agreement to fix the VAT before we carried on. So I just do want to emphasize the importance of just having a little bit of VAT awareness as far as that's concerned. What I have done is just put together a few slides very quickly. A few points that will empower you to have conversations with your clients, and just to give you some context from a VAT perspective. So, what is critical in all instances is sort of getting the VAT clauses right, and I think we are getting smarter and smarter on that. But in the transaction space, the first question that always comes up is it a share transaction? Is it a sale of business transaction? Shares would be VAT exempt and no VAT consequences, at least in respect of the transfer of the business. But there's always a big push that when it is a business as a whole, that it is a going concern, and often those clauses are automatically inserted into agreements. But there are things to think about in that particular space. Things like assets that are not currently being used for the enterprise. So if a client owns the plot next door for the next extension of the factory, and then is going to include that as part of the transaction, does that form part and parcel of it? Does it fit into the zero rate provisions or not? It probably does, but one needs to understand exactly the extent of that and the purposes for which it is held. And the only circumstances, and I don't know if anybody does bare dominium deals anymore, but in those instances the bare dominium is often not part of the VAT enterprise. The second thing that you do just need to be aware of within the apportionment space, so when you've got a mixed business, this very simply could be a commercial and residential building, where you would have the ground floor being commercial, and the units above that being residential and let out. When you sell the building, the whole transaction would be subject to VAT, but it cannot be a going concern unless the commercial component of the building, probably on square meter, there's a debate about what measure you would apply in those circumstances, exceeds 50%. So if you did have a building that literally had 4 floors of residential and 1 ground floor of commercial, that would always have to be, for example, a standard rated transaction. Could never be zero rated, irrespective of the clauses that we may insert into an agreement. And the last point, just around, I think there's often, issues on this. If you don't have a going concern, I mean, effectively, what for VAT purposes, what the going concerns provisions does is they bundle assets and liabilities together to make it a single transaction. But what happens when in fact you can't do that, and there's a transfer of assets in one direction and a transfer of liabilities, assumption of leave pay, for example, or other debt? I mean, isn't that a separate supply, and what are the VAT consequences of that? I'm not sure anybody's ever found an answer for that, but it's something that I mean, they think one must just be aware of. I've already, I mean, mentioned shares as being VAT exempt. I mean, the other instances that comes up quite often, you know, when there's no VAT consequences, is damages payments. I mean, you know, so typically damages would not be consideration for a supply, and there's a whole story around that, starting with a steam train going through a farm. But if we get the wording right, then one could avoid VAT in those circumstances as well. And there's a structure, I mean, around profit shares, specifically in the life insurance industry, that sometimes avoids VAT in those circumstances as well. I thought it was worthwhile, I mean, just, you know, quickly talking about leases and understanding the distinctions between, I mean, where, you know, sort of the a normal rental agreement and an actual lease agreement, which could be a financial lease or an installment credit agreement. There's probably, I mean, understanding generally in terms of the way that operates, but where there are often issues around that is around repossessions and voluntary surrender, and the documentation associated with that, and often the timing about that as well. I mean, just something that probably should be taken into account in setting up those agreements. Cross-border transactions, I mean, is always risky. I mean, I'm sure you're aware of the fact that, you know, the zero rate can, I mean, typically applies when you move goods across the border, or where you provide services to a non-resident, but it is very documentation orientated. You need to substantiate the application of the zero rate, and we kind of have a problem coming at the moment. There's an option to zero rate on FOB sales, for example. And often the exporter of record is in the South African entity and not the foreign client. And SARS is going to start raising assessments to say, in fact, it was not a zero-rated transaction, but a standard-rated transaction, and that should have been claimed. On the importer side, again, documentation is an issue, but there are probably issues around timing as far as that's concerned. They just need to be taken into account in terms of when the input tax can be claimed. I mean, in terms of other aspects that are relevant, I mean, around group restructures. I mean, you know, don't forget about the VAT consequences when you do a restructure. I mean, it doesn't really matter whether, you know, I mean, whether you use in any of the sections in the Income Tax Act of, you know, from 42 to 47. I mean, typically a restructure like this gets avoided for VAT purposes. There are some requirements around a going concern, and there's also a carve-out relating to circumstances that are not included in a section 42 or 45 transfer. So often you make an election to exclude that. What is significant around this is that the going concern requirement under this section is slightly different to the going concern requirements under the normal third-party provisions in terms of a transfer of a business. So you could probably push that a little bit further and not have an income earning activity, but in fact get into the zero rating as well. I mean, it is a little bit of a fiction in the sense that you know, we've got a supply, but there's this deeming provision in terms of being one and the same. So the disclosure on VAT returns and the way that you account for it is always significant. I mean, in the funding space and the discounting space, I mean, it is important to understand, I mean, exactly what's transferred and whether it's on a recourse basis or non-recourse basis for discounting. I mean, it's sort of the mandates and descriptions in terms of what the funding is for. And I'll get to a recent court case about this, but I think there's quite a strong view, and we are going to, I mean, there will be an impact in or probably challenges from SARS in terms of the claiming of input tax on fees associated with funding transactions rising fees that are levied by banks, etc. A little low-known provision, and I'm not really sure whether this makes commercial sense, but I mean, to the extent that we have South African businesses that make loans to foreign counterparties, so often, especially in the infrastructure space, I mean if you look across Africa, there are quite a lot of people that have got that. So you have a South African entity that provides funding for infrastructure across Africa. And I mean, typically your view if you earn interest and dividends is that you cannot register as a VAT vendor. So your asset management fees, for example, would be locked in on that basis, and you can't recover any of that. I mean, foreign interest is in fact zero rated because of a weird wording in the section, so that does make it possible for somebody that would not otherwise be registered as a vendor, but in fact be able to register, maybe on an apportionment basis, being able to recover some of the VAT costs that they incur in South Africa. Non-executive directors, I'm sure that you deal with them on a regular basis, and I mean this has settled down a little bit, but for VAT purposes, there is now a registration obligation for them. Previously, there was already a debate as to whether directors' fees were subject to PAYE. I think the view is now that PAYE should not be deducted from NEDs except for foreign NEDs. But I mean, to the extent that the directors' fees, and that's cumulative from all the directorships, is in excess of R1 million, there is a registration obligation as far as that's concerned, and probably a VAT cost, because in many instances the holding company or the listed entity is in fact not registered as a VAT vendor, although there are, from a VAT perspective, structuring opportunities as far as that's concerned. When you're involved in bad debts and bad debt recoveries, I mean there is obviously, you can claim VAT back if you charge VAT on a particular transaction, and then you have to write it off. You can recover the VAT. I mean, similarly, for recoveries, you would then have to declare it again. I mean, the issue is when there's interest, there's part and parcel of the debt that becomes owing. So you would have your principal debt, you'd have fees, you'd have interest, so you need to get back to actually what you're physically writing off in the circumstances. And for VAT purposes, there's a big debate in terms of what the allocation key is that you use in those circumstances, and whether you have to follow the waterfall in the National Credit Act, whether you can be more aggressive maybe after the event for VAT purposes and get a better outcome. So I mean that's an interesting area in terms of trying to find solutions. Something that is often more complicated than it should be is partnerships or joint ventures, and specifically unincorporated joint ventures. For VAT purposes, a partnership or JV like that is deemed to be a separate person, separate from the vendors. I mean, typically for accounting purposes, for income tax purposes, etc. I mean, it's just part and parcel of the individual partners. I mean, the liability sits with the individual partners, but we do have this issue from a VAT perspective, is that you have to go and register separately as a VAT vendor. You can't just declare the VAT in the individual partners' names. I mean, for firms that do operate as a partnership, as partners come in and out, that VAT number, that partnership VAT entity continues to exist irrespective of the change in partnership. So I mean, I think often it's set up, it's relatively straightforward, but you do just need to know that from a VAT perspective there is this anomaly of a separate registration, a separate VAT entity that is created. But there are massive issues in terms of, I mean, on dissolution, and specifically when you have partners that withdraw and you only have one partner that is left in the circumstances. I mean, that what sort of the VAT consequences of that I mean, there's a different outcome from a legal and a tax perspective versus a VAT possession, and I don't think anybody really knows that because of the separate person exactly how one treats it in the circumstances. So there's a gap there, and if you're not aware of that up front, I mean, there could be a big VAT cost associated with, in fact, dissolving a partnership. Something that has come up recently, just around business rescue. And I mean, sort of the ranking specifically. The way that invoices have, raised, and whether it's got to do sort of when the tax liability arose or when the assessment has been raised. And SARS takes a strong view that it's when the assessment has been raised. I think that's wrong. So I think there's a good opportunity to challenge SARS in those circumstances and make them, part of the compromise on a bigger amount. Because I mean, the significant thing from a VAT perspective is, whereas in liquidation and sequestration, SARS is a preferred creditor. In business rescue, they're not. So I think that SARS sometimes forgets that. So there's an opportunity there just to make sure that the numbers are as accurate as they possibly can be. And I mean, something else that is also relevant in terms of dealing with foreign clients and setting up an operation in South Africa is, we often get the question: should they operate as a local branch? Do they need to register with SIPSI? What are the tax consequences? Do they have a permanent establishment? What are the VAT consequences of that? And again, sort of as in partnership, there's a VAT fiction that is created in those circumstances. I mean, it's sort of even though for everything else you're one and the same entity, for VAT purposes you have this. You have the separate registration, you have the separate VAT number in the circumstances, and then because it's cross-border transactions, you get into this big debate as to whether the zero rating can apply, under what circumstances it can apply. Et cetera, et cetera. So again, to the extent that you do deal with foreign clients that are setting up in South Africa, just think through the VAT consequences as well. So that's literally just a washing list probably of conversations that you may come across in dealing with clients. I thought I would. I know that it is very relevant in these circumstances, but just make the point about Consol Glass. This is a court case that the SCA judgment received towards the end of last year, and it very much had to do with the claiming of input tax on the expenditure associated with the refinance of those operations. Simplistically, there was a restructure in 2007, 2012. They tried to change all the euro funding to ZAR funding. And claimed the input tax. SARS said, forget it. That's only got to do with the capital structure and not your VAT enterprise. And on that basis, no input tax can be claimed. I think that does raise a big question, both in respect of our fees and in respect of raising fees charged by banks, as whether the VAT can be claimed in circumstances. It's probably needs to be determined on the basis of specific facts. But if you're literally swapping banks or changing facilities, then there's a big VAT risk that VAT cannot be claimed in the circumstances. And that would apply to debt restructures. It would apply to sort of movement of shares, etc., etc. So be aware of the fact on that as well. Another point that I wanted to raise very quickly was just around imported services. In Europe they call this reverse charge. Typically if you're a holding company, a listed entity that is not entitled to full VAT recovery, and as opposed to appointing local advisors or a local law firm, you appoint foreign advisors. In those circumstances, when you make payment to a foreigner, you as the recipient of the services are under an obligation to declare output VAT on that amount and include it in your VAT return. Most clients do that. Certainly the big banks and insurance companies. The second thing is around a number of foreign entities have registered as VAT vendors in the last little while. I mean, since April 2019, if that's a little while actually, and that's in respect of electronic services supplied to South African residents. So there is now VAT on invoices that may be issued in dollars or euros, for example, and there are a number of clients that are actually not correctly claiming that, and whether it should be part and parcel of their normal VAT process. I thought I would spend a couple of minutes just on billing arrangements in respect of foreign firms and how that operates in these circumstances. I mean, we do often sort of manage the relationship with foreign firms, and I mean, the kind of on behalf of clients. And I mean, the question does then come up in terms of what is the VAT treatment of that. And very much it would depend on the commercial arrangements. I mean, if we instruct a correspondent and they bill us, so we're the principal in that supply, excuse me, there should be no VAT in those circumstances whatsoever. We would also not be, we would not be required to deal with VAT on imported services in those circumstances either, because we will be making taxable supplies with that amount. It may be slightly different if our clients are billed directly and they're not entitled to recover the full input, then that would have an impact. But so when we are billed by a correspondent and we add that to our bill, I mean, we have to think about the VAT consequences of that as well. I mean, typically we would add VAT on top of that amount, so we would, the bill that would be issued would be, our fees plus their fees plus VAT at 15%. In essence, that's not, I don't think that's really a problem as far as that's concerned, and there won't be issues relating to that. I mean, client more often than not would be able to recover the input tax in those circumstances. But if it is in fact a client that has got an apportionment issue, is not entitled to recover it, there may be an opportunity to zero rate the fees that we've been billed by foreign correspondents. So maybe we can save our clients 15% in the circumstances, and that's worth talking about if you are involved in arrangements like that. On VAT registrations, Julie, just from a timing perspective, shall I cover this quickly, or is everybody in a hurry?
Charles, from my perspective, if you can, that would be great. I think we can certainly give you a few more minutes.
Okay, thank you. I've only got 2 slides left, so I'll deal with that quite quickly. I mean, I thought it was worthwhile just making you aware of some issues around, VAT registrations. I mean, if you're setting up a new entity, if you're doing, in the middle of a transaction and the buyer needs to register as a VAT vendor, just to understand what sort of categories there are for VAT registration purposes. Now, I mean, the compulsory registration limit is R1 million. It's possible to register if you make taxable supplies of more than 50,000 Rand in a year. I mean, what is critical though is this process is very documentation intensive. You need to have all the documents filled in properly. Both from sort of details of the business, the public officer, bank accounts, etc. I mean, the one that gets thrown back more often than not is actually proving that there is turnover or taxable supply in the business. I mean, and this can be done in sort of various mechanisms. I mean, there has to be an agreement, a signed agreement, not just a draft agreement, proving that. There has to be tax, or there could be tax invoices, proving that you've in fact provided services or sold goods. I mean, they're preferably, not 1 but 3 or 4, and showing the limit. And there are some instances, where there's a bit of a lag from the time when you will in fact start making taxable supplies. There is an expenditure. I mean, if you can prove that you've incurred expenses for that, you can get into the VAT net as well. And then there are certain particular activities, like prospecting, where there's no real prospect, if you will, of earning taxable supplies in the foreseeable future, so that you can recover the VAT in those circumstances. That's possible as well. What is important as far as this is concerned, it is these days relatively easy to get a VAT number, so it does get issued when you attend. I mean, you have to make an appointment with SARS, and they typically issue the number there and then if they accept all the documents. I mean, sort of senses that it takes a couple of it probably takes 2 or 3 weeks to get all the documents together and sorted and everything in place, but you can achieve a VAT registration within a couple of weeks. It's also comes, I mean, if you have a compulsory registration, it is possible to backdate it if that's necessary in the circumstances. But I mean, a voluntary one you can sort of backdate to the beginning of this month and maybe the beginning of last month, but you can't do that. So just think about, I mean, the requirements in terms of sort of registration as well, and you know, what the right time is to register, because obviously it could have a significant cost if one doesn't get that admin in place. The other thing is that if you need to do a backdated registration and you have in fact made supplies and forgotten to charge VAT in these circumstances, or you should have been registered, you can use the voluntary disclosure program, but you must have dealt with that within, I mean, that your VDP must have been submitted within 30 days of having effected the VAT registration. Now, I hope that's helpful information. I thought I would just conclude, you know, very quickly in terms of sort of the VAT services that we deal with on a day-to-day basis, so I can get a bit of a sales pitch in. I mean, obviously a wide range of consulting, including review of contracts and adding the VAT clauses. I mean, we do a lot of work around, I mean, VAT rulings and getting binding rulings from SARS. I mean, it is significant that, you know, for VAT purposes, there's a separate process. You don't need to go to the advanced tax ruling regime, so you can get a binding ruling. I would say relatively easily, I suppose. I mean, obviously there's a process, but it's a reasonable process. We do assist in facilitating, I mean, the SARS audit process. We've often got good relationships even with the audit teams, and you sort of can be the interface between clients and SARS in those circumstances. Do a lot of work around dispute resolution, right from, you know, objection phase through to taking it to the SCA. In fact, we, you know, and busy with 2 disputes at the moment where we're going to go to court to get a declarator. On the VAT registration side, I mean, we can provide that service. We do have regular access to SARS and understand that process reasonably well, so that can be in a streamlined basis. And then there's, I mean, on the apportionment space, I mean, as I say, holding companies, bank, life insurance companies, and in fact, even people like credit retailers, etc., and even I mean, sort of the building that I spoke about that is a mixed use building. I mean, we're good at designing apportionment methodologies and getting approval from SARS from that, and there is an annual requirement to update that apportionment ratio 6 months after year end. So doing that true up calculation and I mean, providing checking whether it is still an appropriate methodology is something that we do on a regular basis. And a new service that we've introduced is around a VAT transaction review, which is pretty much using technology and doing a review of data, where these days we do that on a success fee basis in selected circumstances. So that very quickly, just a sort of a run through from a VAT perspective, and I mean, sort of issues that hopefully you can deal with your clients. So I'll stop there unless there are any questions.
So, Joel, thank you very much. I know that was a little bit of a greatest hit. I should actually have given you more time, so my apologies for that. But I think what I will do is I'll share that presentation with everybody. And then obviously encourage them to chat to you about particular issues. But I think the point is I think well received by all of us, that there are a number of complications around these things that we should be aware of. And I think actually also, to be honest, we as commercial practitioners are probably not aware of all of the, you know, those offerings that you do have there, and how relevant they could be in the commercial context. So I think there's some work we can do on our side as well to see how we can make more use of that. And I'll chat to you separately around that, but I think there are definitely opportunities. And then just from my side, thanks very much. I think it was very comprehensive and easy to understand. So yeah. Cool.
Great.
So I don't know, folks, if anybody does have a specific question. I know we're running over time. Otherwise, I would encourage you very strongly to have a look at what Charles put in front of us and engage with him directly. Cool. Everybody's sufficiently intimidated. Okay, great. Charles, thank you so much for your time, and thank you as always to everybody on the call. Okay, folks, have a good Wednesday.
Have a good day.
Cheers, bye.